So I don't really want to talk about index universal life insurance or life insurance per se this morning. I want to start in a different place. I want to start, as you can see on this presentation, with the whole concept of retirement and estate planning. Okay. The reason for that is because I don't intrinsically find life insurance that interesting, and I do it every day. It is my business. But I do think that retirement and estate planning is something that is interesting to most people. Certainly with people with the amount of wealth that probably should be looking at this solution. Okay, just before I get going, I'm just going to give you a little bit of background. Again, forgive me, some of you will have heard this. Really, we're a broker and an advisory firm that helps advisors around the world understand these types of products and how to put them in place with various structures that you need to do so. I think the great thing about this product is you can drop it into 150 countries globally. So you're not confined to parts of Africa or to Africa in itself. You can go wider than that. Whether or not you're allowed to, I don't know, but I'm just going to give you a scope. Hong Kong, Singapore, Dubai, those are some of the hottest markets in the world for this. China as well, of course, now that we're coming back out of lockdown over there. Just to give you this is not boastful, this is just trying to give you an idea of the scale of this solution. The largest one I've done today is $120 million on a single life. So you've got a lot of capacity in terms of wealthy individuals, and you can go all the way down to $1 million as well. On the screen, there's some of the people I've had the pleasure, mostly pleasure, dealing with. Sometimes there are exceptions in there. But really interesting people from all sorts of walks of life and different businesses. And one of the things I'd like to help you do is like to help you grow your business in this area. Obviously, it's mutually beneficial to both of us, but I think I'm probably reasonably good at that. I helped a bank grow its business 10 times in 2 years with a small team of people, and I can certainly, hopefully, help you position the solution. Okay, right. Let's get into the presentation. When I showed Bob Parker this, he thought I deliberately used the word Bob because it was going to appeal to him, and I hadn't. But then I thought about it and thought, well, that's actually not a bad idea. So let's meet Bob this morning. Okay, we're going to take a very, very broad example of what Bob may look like, and I don't want you to particularly worry about the numbers that you're seeing. It could be applicable to you, and you can fund these in different ways. Okay, but let's just go with Bob to start with. He happens to have $1 million of cash. He wants to take 5% income each year from his portfolio in retirement. He's got a pretty long time frame to retirement and in retirement, and he's looking for around 7% yearly returns after costs and charges. Okay, I just picked that because that seems to be reasonably typical, and we've got to start somewhere. Okay, so take a look at this. Here are returns from 3 traditional portfolios. And the first thing I think you're going to notice is that those returns never happened. They are completely made up. But the data is from BlackRock, which is one of the biggest asset managers in the world. And it's just there to prove a point, I hope, which will be on the next slide. So if you cast your eyes across all those portfolios, 1, 2, and 3, the question is hopefully self-explanatory. Which portfolio would you choose as an advisor? Now, we've got a very big room and I'm on Zoom today, so I can't really go around the world and ask everybody what they would choose. But for full disclosure, before I even looked at the answer, I chose portfolio 2. I think it's probably because I like consistency, something to do with that. But I've had all sorts of answers over time, everything from portfolios 1, 2, and 3. And I think that the reason for looking at this is exactly this point here. Each one of these portfolios delivered 7% yearly returns, yeah, on average. 7% on average. Every single one of those, if I just whiz back up, each one of those on average has delivered 7%. But you can see that they delivered them in very different order. So portfolio 1 was probably just about okay. It's okay. Portfolio 2, the one that I chose, is not brilliant, but hopefully the guy doesn't run out of money. And portfolio 3 was a complete write-off. And I think what's interesting about showing you this, hopefully, is this is all to do with sequence returns risk. And that is basically the danger that as your clients are coming into or up to retirement, then if they're hitting retirement in the wrong time point and markets start to dip, and drop in value, they do have a very real danger of running out of money in their retirement. It's a risk that I think lots of us don't always think about or don't always talk about, and I think it's one that this product or this solution will help. Okay, because if those returns happen, and I'll give you a real life example, if those returns happen, we're going to have to either delay retirement or we're going to have to rethink how much income we're going to get in retirement. Okay. One other point you see on that slide there, I talk about diversification. I get it. It does help, but it's not the only game in town. It is, when I was at the bank, I saw a portfolio which was made up of commodities, hedge funds, property, etc., and it was off over 50%. So diversification certainly helps, but it's not necessarily the golden ticket. All right. Okay. So if scenarios, perhaps 3 in particular, and maybe even 2 were to happen to Bob, here are some of the choices he would have to make. He could stop taking income from his portfolio. Well, not really, because he's just entered retirement, perhaps. He could reduce his income to stop the erosion. Again, that's not very helpful because inflation around most parts of the world is very high right now, typically between 5 and 10%, and I suspect in some African countries it's prevalently high all the time. Or he could sell his house perhaps to provide more capital, and none of those are outcomes that you, Bob, or we want to see happen. Okay. Here is something that may have happened last year. If you look at this table here, I'm just trying to exemplify the point I'm making. Okay, you've got last year, many markets or many portfolios were down around 20%, some more, some less. But if we just take this as an example, if last year we had retired and our portfolio was down 20%, and then we'd chosen to take our 5% income in there, well, just to break even again, the portfolio would need to pull back 33%. In other words, a third of the value. Pretty big number? It's a pretty big number to me. And I saw one client, and it was towards the end of last year. They had planned on retiring. They had, and I'm just rounding the numbers for the ease of demonstration, they had around $3 million invested, and they were proposing to take $150,000 a year. So 3 million was now worth 2.4 million. And if they had taken their income, it would then be worth 2.25 million. And they started with 3 million for their retirement planning. Do you think they were comfortable? No, is the answer. Okay, just in the, you can see this sort of ticker tape effect down the bottom. And that's what I thought when I was putting the slide deck together anyway. Here's a kind of ticker tape of returns just in the last 23 years. If you had started retirement in 1999, you'd have gone through all of these crises or all of these market drops. And so we need to be cognizant of it, i.e. the returns risk. Okay. All right, let's move on. Okay, here is the punchline. So what has this got to do with index universal life insurance? So as you can see, it's actually got quite a lot to do with it really, because IUL, as I'll shorten it to, is not so impacted by the sequence of returns risk. And I think there are 2 things I want you to remember, please, from today's short presentation. And here is one of them. It's that line there. Okay, I'll read it just for the sake of completion, but perhaps for the sake of the tape. Bob is guaranteed to never lose money from stock market losses in an IUL for the rest of his life. Now, apart from those who've heard this presentation previously, I'm hoping most of you probably haven't heard that either. It's a very, very big claim, and not many companies can make that claim. A bank could certainly not make that claim because their business model doesn't allow them to do so. But things like an insurance company, they can make that claim, and they can also back it up as well. Okay, so Bob is guaranteed to never lose money from stock market losses in an IUL for the rest of his life. Does that become interesting? I'll take some yeses, hopefully, in that. Okay. A quick reminder for those who know, and a quick definition for those who don't. So IUL is actually a whole of life insurance policy. It's designed to last for the rest of a client's life. Okay. And when premiums, or I prefer to see it as an investment, goes into an IUL policy, It'll go into the cash account, and some will go off to pay for the cost of insurance, the whole of life cover, the death benefit, as we'll see. And the rest will go off and it'll be invested by the insurance company, and it will capture some of the market returns, okay? The one I'm going to talk to you today is about the S&P 500. And the reason for that is because it's easy to understand, it illustrates well, and it's just pretty straightforward and simple to look at. Okay, so how can an IUL help Bob in his retirement? Well, we know that for most retirees, they're going to have a long time in retirement, okay? So I've just taken here, please forgive it, it's very geographic centric, but a 50-year-old in the UK today, he would on average expect to live to 84 years old. So that's a pretty long time, that's 24 years. And this, in this case, he's a high net worth individual. So on average, you would expect him and or her to live longer, okay? So we know as advisors, we need to get some stock market exposure because we've got a long time in retirement. And unless you're deeply wealthy, bonds and cash are not going to cut the mustard. Okay, so we need some inflation-proofing assets like stock market returns. So we know that the stock markets offer best long-term potential, but as we come up to retirement or into retirement, we're not quite sure we want such a bumpy ride. Okay, right. Let's take this example then. So Bob now takes us $1 million and he puts it into an IUL. We're going to link those returns to the S&P 500 inside the solution. So he's going to get 100% upside in the S&P 500, but he's going to have those returns capped, and the returns are capped out at 10.7, and those increase later in the life of the investment to 12.55. Okay, but just focus on 10.7 for the minute, and then it will kick up to 12.55, which is a new development. Okay, so in other words, if the market does 26% this year, any hands up for S&P 500 this year, 26%? Probably not. But when it does do 26%, Bob is not going to get 26%. He is going to get 10.7. So his upside is capped. All right. But here's the rub with this. He's got a zero floor in this solution. Okay. So do you remember that phrase? Bob is guaranteed to never lose money from stock market losses. So here we have the guarantee coming in. His capital is protected from any downside risk in the market, okay? He's got the annual floor, it resets every year. What's interesting about this floor is so let's say Bob's $1 million goes in and the S&P is at 1,000 points. I know it's not, but let's say it's 1,000 points. And then the market drops to 500 points. So a 50% drawdown, yeah? He's lost no money, but he will reset at 500 points. It has another nightmare and it falls another 50%, so it drops down to 250. He will have made no stock market losses and he will then reset at 250. So you can see it ratchets down, but he's made no losses. And as soon as it starts moving up, he will collect up to 10.7 or 12.55. All right, okay. So let's have a quick look at an example. Some of you are probably too young to remember this. Sadly, I remember it very well. This is the huge market correction in the crisis. And this is when I saw the portfolio as I looked at the bank was off more than 50%, even though it's diversified. Just remember this one in this 4 of the most consecutive years of losses in the US stock market. Okay, we'll come back to that point in a moment. Okay, so IUL. How on earth, this is a whole of life insurance policy, how on earth can this help Bob? Well, he's got the ability in some solutions to take 5% free withdrawals. So what we could be in a position is if we pretend for a moment he's got a discretionary fund management service with $1 million in, which has dropped in value, and he's got an IUL which hasn't dropped in value, but also he's got $1 million here, which one are we going to go to take the retirement income? I'll answer it myself, again, for the ease of presentation. I would go to the IUL and I would take 5% from that because it's made no losses, and I'd leave my DFM to recover because we don't want to be taking money out of a portfolio that's falling in value, which reminds us that actually when we are increasing in value, we probably should take some profits, especially if we're in retirement, okay? IUL basically increases the returns that the client will get, and it reduces the risk. There's a number of mathematical studies on that, but it's a very, very helpful diversification tool, and it does something different to your DFM, which is chugging away. Okay. So now I do want to talk about life insurance for a moment. Let's remember, fundamentally, the IUL, it's a whole of life policy. It is designed to last the rest of a client's life and pay out upon their death. And this bit, or the second bit that I would like you to remember today, please. So in our example, when Bob is finished with his retirement, which is a polite way of saying he dies, he can leave the policy's lump sum insurance payout to his wife, kids, etc., etc. Now, Bob invests $1 million at age 50, and this is a real example. We did it last year. He invested $1 million at 80, and his family will get $3.4 million whenever he dies. Okay, once his $1 million goes in, the insurer will pay his family $3.4 million whenever he dies. But if he's in retirement, it will also be paying him $50,000 a year in my example. Okay, interesting. Hopefully there's some nods going on. Hopefully that's interesting. Okay, so one of the things that we often get at this point is, that seems too good to be true. Do we believe it? Okay, show me how that works. So I just want to go on and prove to you how it does work. Okay, I'm going to flick across now to the illustration, and you'll be relieved probably to know that this is my final slide, but we might just spend 5 minutes on it. Okay, this is Bob. His name was actually Carl. He was over living in China. He was, when he took it out, 50, and he was a non-smoker. And you can see there's his $1 million of premium or investment going in. And you can see that I wasn't making it up. There's the death benefit the insurance company will give him whenever he dies. All right. Okay. Now, I just want to concentrate on this column here for a moment. End of year guaranteed assumptions, minimum rate, maximum charges. This is what I like to call the Armageddon scenario. Okay. This is the worst thing that could possibly ever happen under this solution. It can't get worse than this. It can only get better. And that's why I like looking at it, because most illustrations you see will always show you the rosy picture, or it'll go, oh, your investments will grow at 5, 7, or 9%. It's hogwash. It's made up. It's obviously just for illustrative purposes. But this is actually based on some reality. This is going to show us two things. It's going to show us the Armageddon scenario, what's the worst that could ever happen, and I'm going to show you that now. And on the right-hand side, it's going to show us what has happened over the last 25 years to give us some confidence in the solution. Okay, sorry, I'm just going to move you around the screen a bit. So I'm going to focus on this left-hand column, and you can see we're going to whiz down here. Keep needing to move you around, sorry. Okay, down to this point here. And you can see in year 27, which I've highlighted here, it's going to go hash hash across the screen, all right? This means to say that Bob Carl has put in his $1 million, and at this point here, there is nothing left. There's no death benefit, there's no surrender value, and there's no withdrawals, okay? So there is the possibility that this policy will completely blow up and not return any money, okay? However, here's the rub. For this to happen, Bob, in this scenario, would have taken out $600, $700, $800,000 of his own money. Yeah, you can see those withdrawals coming down. Yeah, he started to take out in my modeling from year 11 onwards. It would also require the S&P 500 to fall every single year, 7 years in a row, and never rise in any one of those 27 years. Hands up if anybody thinks that's going to happen. I can't see any hands. I'll assume there's no hands, okay? So that is the Armageddon. So Bob's put in $1 million. He's had $800,000 of his own money back. And on top of that, the S&P 500 has fallen for 27 years and never risen in any one of those 27 years, okay? I think a rational man or woman, or every other variation, would say that's not going to happen. If we look back, do you remember that magic number I had earlier? 4. 4 is the magic number, okay? So let's assume that we're all good for that. And I'll come on to what has happened. So this is the column where the insurer says, or the regulator, should I say, actually says to the insurance company, you can't make this number up. You can't put 12% in there, yeah? As a broker and an advisor, I can't change this illustration. You can't change the illustration, and neither should we be allowed to, because this is showing what has happened on average over the last 25 years, and the number's 625, okay? Right, now we're going to have a different scenario, and we're going to whiz down to this point here. This is just for my ease of brain at this hour of the day in the UK. Okay, so at age 80, we can see that Bob has put in $1 million. He's had $1 million of his own money back, okay? And in this instance, he's still got $2.1 million of cash value in the policy, or if he dies at age 80, it will convert to $3.4 million, okay? Finally, final line of this presentation. Bob's put in $1 million in my example. He's taken out $1 million by the age of 80. He's still got $2.1 million on a back-tested basis in the policy, or if he dies, it'll convert to $3.4 million. That's it, I'm done.